Episode 4, Market Structure: How to Read the Market Without Indicators. Before we begin, I want you to think about something honestly. Have you ever opened a chart and felt overwhelmed? Too many lines, too many signals, too many opinions, and after all that effort, you still felt unsure. If that sounds familiar, this episode is extremely important for you. Because today, we strip the market down to its raw structure. No complexity, no clutter, no confusion. By the end of this episode, you will understand how the market moves even without indicators. Why market structure is the missing link for most people. Many people jump directly into indicators, strategies, entry and exit rules, without understanding how price is actually built. That is like learning to decorate a house without understanding its foundation. Market structure is the foundation. It tells you who is in control, whether price is healthy, whether a move is strong or weak. Without structure, everything feels random. With structure, clarity appears. What market structure really means. Market structure is simply the way price moves over time. Not why, not news, not opinions, just price behavior. At its core, the market does only three things. It moves up, it moves down, it moves sideways. Structure helps you understand which one is happening and why. The language of price. Price communicates through highs, lows, and swings. These swings are not noise. They tell a story of strength, weakness, balance, imbalance. Once you learn this language, charts stop looking complicated. They start looking logical. The three basic market conditions. Every chart on any time frame will be in one of these three states: uptrend, downtrend, range. There is no fourth option. Understanding which state you're in changes how you act. Uptrend, when buyers are in control. An uptrend is defined by higher highs, higher lows. This means buyers are willing to pay higher prices. Sellers are unable to push price lower. Emotion during an uptrend is optimism. Confidence grows as price respects structure. But here's the key lesson most people miss. An uptrend is not just rising price. It's healthy pullbacks followed by continuation. Without pullbacks, trends become fragile. Why beginners misread uptrends. Beginners often buy after long moves, near emotional highs. They confuse movement with safety, but experienced participants watch how price pulls back, how it reacts at previous levels. Structure matters more than speed. Downtrend, when sellers are in control. A downtrend is defined by lower highs, lower lows. This means sellers are aggressive. Buyers fail to defend price. Emotion during a downtrend is fear. People become reactive. Many beginners make the mistake of buying just because price looks cheap, but cheap can become cheaper. Structure warns before damage is done. Why downtrends feel so dangerous? Downtrends accelerate fear. Losses feel heavier. Confidence disappears faster. This is why understanding structure is protection. It helps you avoid fighting the dominant force. Range, when the market is balanced. A range occurs when buyers and sellers are evenly matched. Price moves between support and resistance. This phase feels confusing. People say, nothing is working, the market is stuck. But ranges are important. They're accumulation zones, distribution zones. Structure tells you which one it is. Why most people lose money in ranges. Ranges trap impatience. People overtrade, they chase small moves, they lose discipline. But ranges are not bad, they're preparation phases. Understanding this prevents frustration. The importance of highs and lows. Highs and lows are the backbone of structure. They show momentum, weakness, transition. When price stops making higher highs, something is changing. When price stops making lower lows, something is changing. These changes appear before trends reverse. Structure breaks, early warning signals. A structure break happens when an uptrend fails to make a higher high or a downtrend fails to make a lower low. This does not guarantee reversal, but it demands attention. Structure breaks are early messages. Ignoring them is costly. Why indicators lag structure? Indicators are calculations of past price. Structure is price itself. That's why structure changes first. Indicators respond later. Indicators can support decisions. They should never replace structure. How institutions read structure. Large participants focus on where price reacts, how price holds levels, how price behaves after movement. They don't guess, they observe. Structure gives them context. Why structure works in all markets? Structure works in stocks, indices, commodities, currencies. Because structure is human behavior expressed through price. Behavior doesn't change across markets. Common beginner mistakes with structure. Some common mistakes include drawing too many lines, changing structure based on emotion, forcing patterns. Structure should simplify charts, not complicate them. If your chart feels confusing, structure is not clear yet. How structure connects with market cycles. Structure and cycles work together. Accumulation often appears as a range. Markup appears as an uptrend. Distribution appears as a range near highs. Markdown appears as a downtrend. Once you connect these, charts tell a complete story. Why this episode is a turning point. This episode shifts you from reacting to price to reading price. Most people never make this shift. If this episode is helping you see charts differently, pause for a moment and let that sink in. This understanding builds slowly but stays permanently. How to practice structure daily. You don't need to trade, just observe. Identify the trend, mark key highs and lows, note transitions. Observation builds skill faster than constant action. Why fewer trades often lead to better results. Structure encourages patience. Patience reduces emotional mistakes, overtrading, regret. The market does not reward activity, it rewards timing. What comes next? Now you understand who moves prices, how cycles form, how structure reveals control. The next episode focuses on support and resistance, the most under-mystified concept in the market. That episode will show you how price remembers levels and why reactions repeat. Make sure you continue this journey because every episode builds directly on what you've learned so far. Final reflection. If you've reached this point, you are not just watching, you are learning. And learning market structure is one of the most important skills you can develop. If this episode brought clarity, share it with someone who struggles to read charts. Teaching others reinforces your own understanding. This concludes episode 4. The foundation is now solid. The next episode adds precision.
Thank you for watching. Like, subscribe and share to get similar kind of videos.